Good evening to everyone who has joined us today, who has taken out time for this markets meetup. Thank you so much on behalf of the whole Samco Mutual Fund team. I am Chirag Joshi, the Chief Growth Officer of Samco Mutual Fund. We at Samco believe in courage and speed. And courage is to do things differently, and speed is all about technology and control. Today, when the markets are at around 8,600 levels, it is extremely difficult to give a markets outlook. But here we are, our CIO, Mr. Umeshkumar Mehta, will take us through where the markets are heading and some insights on what are the opportunities that are available for investors to at these levels. So without wasting any 18,600 Nifty. So without any delay, I would request Mr. Umesh Mehta to take over the stage and take us through the markets meetup update.
Thank you, Chirag, and a very warm welcome to each and every one of you. It's not the market, whether markets are up or down. It is how we are on the right side of the market, and that is how we need to place ourselves. So yeah, there is a lot to talk, and currently the markets are at new highs. People are skeptical. Should I invest now, or I will be left out? Investor sentiment is not that great. Still, there are worries of inflation, interest rate, and markets have moved up so quickly that it's very difficult, even for a layman, to understand that. He also knows that, markets have gone up. Is it right time? Yes, no to invest? So all those things, what I'm going to share today is factual data rather than putting or someone else's opinion or mine opinion. We will see with an unbiased data where the markets stand, and thereafter we will arrive at a way forward. So Chirag, my voice is clear, no? Thank you. So let's begin. So what to buy at current markets? Let's understand. So this is standard disclaimer. Obviously, examples that we will discuss, or for that matter, past returns are may not happen in future. So let's begin. What is the big picture on global interest rate? See, understanding of this canvas is very important, because ultimately the cost of business, that is money, we need to understand is where interest rates are heading. Because if we get this piece right, we are going to lay a broad foundation, a broad canvas, where markets will move ahead. And getting this right is very important. So let's see on this. So this is bond yield spread, US bond yield spread, 2-year and 10-year. So why US? Because America is around 30-35% of global money markets, and bond yields 2 and 10 are very liquid. They depict where sentiments are, or where people are betting that how cost of money will henceforth play out. So if you can see over here, recently in the month of November, December, the spread has widened. Earlier, right from the elevated interest level that we have seen since last 8-9 months, that the spread was narrow. It is only this time, for the first time, your 10-year bond yield, your 10-year bond rates have started to fall far harder. And this, what we see, is a turning point. And now, cost of money will not remain at elevated level. The top has been made, and steadily it's going to move lower. Understanding this piece is very important, because this is going to set the stepping stone for the mega bull market. And if the interest rate, if the cost of money or interest rate keeps on steadily falling, we are going to see return by equity. People will want to take risk. Global money would like to flow from bond to equity, and that's how mega bull markets will emerge. So this piece is very important. Let's understand one more fact, and this is very important. For the first time, Fed rates, your 10-year bond yield penetrated the Fed rate. This to us is an indication that the interest rates have peaked and the time for correction has begun. Time for fall has begun. And when investors and when global equity investors see this, they are going to put a lot of money. Currently, only bond market is seeing this. So this intersection is very important, my friends, to understand a global canvas, where markets are heading. The cost of money is going to get cheaper and cheaper, and all those money is going to go into risky assets, businesses, and equity markets. So assuming that Fed stops interest rate increases, from that month onwards, the next 1 year return is massive. So there are these 13, 14 observations in the past history that we have seen. And the next 1 year, S&P 500 increase is around 14% from the month Fed stops the interest rate increase. So this is what a great scenario is. And our thought process is that given the movement in interest rates, that time has come. And the moment Fed gives a pause, and from thereafter a fall will begin. So from that pause, we see a massive rally in US market, and obviously the cascading effect will also be visible in a far more intensity in our Indian markets as well. So this was broadly a global canvas. Interest rates have peaked, they have started to fall. And once that fall happens, these are historical returns that I have said in past. Fed S&P 500 on an average has increased by 14-15%. And this is what we are going to see going ahead. So let's understand our global stock market profile. So this was purely on the interest rate cycle. So let's understand the global landscape. These are Dow Jones Industrial Average and Russell's 2000. So Russell's 2000 is what we call as a mid-cap or a small cap and mid-cap kind of category, wherein we can measure the investor sentiment in US markets. Dow Jones is a large cap, is a bucket of all those great mega businesses. So when the bull market comes, the first leg of bull market, it is only the large caps that move higher first. So if you see, this is Dow Jones Industrial Average and Russell's 2000 is still lagging. See, the gap is also widening. This indicates that when the bull comes first, they are the large caps who get the first share of money. It's the small and mid caps that comes later. So this is where we are today in the US market. Over there, American investors are still not convinced, and therefore this index is lagging and falling behind. But soon this is going to change, and we will see a massive upswing. So this is a short-term view. The prior slide was 1 year view. This is also a short-term view, wherein the Russell's 2000 index is still lagging compared to Dow Jones Industrial Average. So this slowly and steadily, the small caps and mid caps will take over. So what about the Indian stock market? Yes, understanding this market is very important because eventually we are in India, and it is our investors who are going to look at those markets. So it's the same thing as I told you. Investor sentiment across the globe. I repeat, investor sentiment across the globe currently is same, whether it's America, Britain, Asia Pacific region, or India. So here you can see Nifty is racing ahead far higher than compared to the Nifty small cap. If you see over here, the first leg of bull market, as I told you, money first moves to large caps, mega caps, and that's why they move higher first, and then it's a turn of small and mid caps, which currently is lagging. But soon I will show you, how when bull markets emerge, small and mid caps take over the large caps. So this is where today we are in India. Similarly, as compared to US market, it's the same picture. Indian investors are still they are still fearful. They don't want to take risk, and they don't want to bet aggressively on the equity side. And this is what is also seen in the Indian context. So same short-term view, as I told you, small caps are lagging than the large caps. So now let's understand when will a mid and small cap. So mid and small caps are yet to catch the bull market rally, and what shows this. So this chart will show this. So this is the mid small cap 400 ratio compared with Nifty 50. So as you know, that NSE has this index mid small 400, which comprises of this universe. And when we see this ratio with Nifty 50, the large caps. So let me explain you what we are saying this. So this period, the zone in green is a zone of outperformance. So here Nifty mid and small cap 400 has massively outperformed compared to the Nifty, the large caps. Over here again, then there was this period of underperformance. Again, there was a period of overperformance when large caps were down and mid and small caps were having great time. Similarly, over here, again, this was a time of overperformance when mid and small caps had outperformed. And now if you see in this late phase, your large caps are moving higher, but this ratio is still down. Now is a time when in that phase of outperformance of small and mid caps has come. So this is what we think is going forward the scenario when risk is on, when interest rates are falling, and it's time when mid and small cap are running and they are at a cusp of a major push up from the investors. So the biggest question, are markets at top? Markets are at lifetime high and it's started to correct since last 2-3 days. There are a whole number of reports that markets may not sustain. Indian markets have moved so quickly and it has moved very fast. So let's again understand the factual position of our markets. So in order to understand, so before delving into this chart, let me explain. See, bull market, the heavy lifting is done by the bulls, and that's how bull market emerges. So the most scientific way to measure what's the strength of the market is by measuring percentage of stocks making 52-week high. And this is what is very important. Currently, the percentage of stocks making 52-week high is only 3% over here, as you can see. But since last 1.5 year, this number is at around 11-12%. So when a high number is reached, that's the time we can say that, oh, the sentiment is great. There are a good number of people that are into market. There is euphoria. There are so many stocks hitting 52-week and lifetime highs. But currently, although market Nifty is at probably lifetime high or previous level, but number of stocks are still minuscule, only 3%. So this is what we say. See, after night, just like day comes, and this is just a beginning. As more and more stocks hits 52-week high, as bull market develops, that's the time we can say that market has reached the top, and not now. Currently, because markets may have reached top, have reached at this level, because as I told you, large caps are moving higher, and Nifty 50 is a conglomeration of large cap stocks, and some stocks have huge weight. But those just half a dozen stocks cannot dictate, are in fact putting Nifty at this level. But the broader market where the juice is and where investors want to invest are still at lower, and they are still at the bottom. And as I told you, 3% is just a minuscule number. It cannot make a market top. Markets, when number of stocks making new highs increases month after month, quarter after quarter, and when they reach that extreme, that's the time we can say that now markets have reached the top. So let's understand a historical perspective when similar situation that we are seeing now we have seen witnessed in the past. So let's understand this 2005 period. So this sometimes in March of 2005, this market had reached top, and the number of stocks hitting 52-week high, percentage stocks was 27% over here, as you can see. Then thereafter, again, market reached its previous levels, what we say as double top, or currently where we are in the current scenario. But if you observe, number of stocks, percentage of stocks hitting 52-week high, just 40%, nowhere near the peak. And people were dubbing that this is again a bull market top, and the markets are falling. That's no point. The breadth is weak. and let's sell and get out. But they all got it wrong. This is what happened thereafter. The market kept on rising. And when the number reached that extreme level, as I told you, 27, 28% during that time, that was a time when market had reached an intermediate top. So in order to understand where the markets are, you need to understand the strength of the bull. Currently, it is at a very nascent stage. Hardly 2-3% of the stocks are at 52-week high. And this going forward has to increase. Then and only then we can say that market has reached euphoric levels. Markets are now ready for a major correction. Currently, markets are nowhere that you are at euphoric level, and still there is long way to go for the bull market to develop. So as I told you, let's measure the current investor sentiment. There are various ways of looking at it, and one of them is a new account being opened, demat accounts. So this is a CDSL data, and if you see continuously the new accounts open rate is falling, number of accounts that are being opened are falling. That means what? Investors are not coming in equity. They don't want to take risk. They don't want to invest in equities. That's the time when smart investors comes in and buys. So this is what our thesis is, that because all these sentiments are weak, they are poor, number of stocks hitting F&O bank are just 3. Today, when we see, if market is at double top or all-time highs, number of stocks hitting F&O band has to be in more than dozen, 15, 20 stocks when they hit. That's the time we can say historically, oh my God, wow, markets have made a bull market top. But currently it's only 3 stocks. And given that sentiments are weak, new demat accounts are not being opened, all this combined, when we have a holistic view, we can say that this may be a top wherein we will see some correction, but this by no chance is a major top. Still a bull market is ahead of us, and we will see more of that, because as bull market we have seen, market always climbs the wall of worry. Nowhere, even in 2004 when Sensex had reached that previous peak of 6,000 Ketan Parekh top, everyone was bearish that, oh, market has again reached the top, let's get out. But market kept on rising higher and higher, and eventually it entered into a mega bull market. So that probably is a time, when sentiments are weak and people don't want to add on, but markets are giving an indication, because markets are at high, but internal number of stocks are still 2-3% stocks are still below are 52 high. So this number is going to increase, and we will see a massive bull market emerging. And therefore, it's our duty as asset manager and you as partners to tell our investors that, look, hey, this is the time you have to load up the stocks, because now if you will not be able to buy 20,000 Nifty, you will not be able to buy 25,000 Nifty. Now is the time when markets are consolidating, markets are giving you a worry, markets are, the sentiments are negative. That's the time you should enter, because when the euphoria sets in, that's the time the returns will get shallower and shallower. So this is a recent newspaper headline and business line that only 5% in BSE, only 5% stocks are hitting a lifetime high. That means what? This is a clear indication that a huge number of stocks are still waiting to hit that lifetime high ground, and therefore you buy everything, and that's everything is going to go up. Because see, the nature of market is very clear. After day, night is going to come. So that's how the 6 cycles are there. So we had a major correction of Russia-Ukraine crisis, be it recession, be it high interest rate. So everything got culminated, got discounted, and we have hit a major bottom sometimes in mid of June and July. So here, from now onwards, markets have started their upward journey. And the first leg of bull market, as I told you, people are skeptic. A market climbs a wall of worry. Large caps are the one to get gobbled up. It is the small and mid caps that lag. But now is the time. Now, when small and mid caps, when confidence returns and US interest rate, US Fed rate, when they start falling, that's the time investors will come and come running in the market. So before that, it's our duty to tell our investors, it's time to invest now. Again, the outperformance and underperformance of small and mid caps. At times, there is outperformance of 20-22%, and at times there is underperformance. So now we had a phase of massive underperformance of small and mid caps at around 10-12%. Now is the time when, as I told you, when risk is on, when interest rate starts falling and the process has begun, it is the mid and small caps that will again outperform and will be the flavor of the season. And people would like to generate that alpha by betting on small and mid caps. And this data, the next slide I'm going to show you, is amazing. This is 100-year-old data that we have culled, and this is what happened in USA. So in Americas, does this theory work that when we invest in small caps, so that time there was only large cap and small cap. There was no category of 100 years ago that US market had. So there are only two categories, small cap, which currently we say mid and small cap, and large caps. So from 1929, this data is there. So from 1929 to 1945. So you had this major bull market top of the century in 1929. And thereafter, you had a Great Depression, and again a massive comeback and a World War II. If you see that phase, entire 15 years, the CAGR return, compounded average return of large caps, real return was 3.5%, but small cap was double, 7.6%. So this is what the potential is, my friend, of large caps. As and when, so this is what we have seen in Americas of the past century data, that when risk is on, when bull market is on, it's the small and mid caps that deliver fantastic returns. And currently we are in that same space. As I told you, the Fed will pause, and that signal we are getting from the bond yield spread, 2 and 10 year. The spread has widened, and this is a first indication that a mega bull market is emerging, because this landscape, the cost of money is now reducing and falling. US market, as I showed you, small caps are still lagging over there also. Large caps, the bull market has begun, and slowly this will catch up. In India also, this is the same space. Small and mid cap are lagging. It is the large caps that have first begin their rally. And as I told you, this is not a double major market top, because percentage of stocks making 52-week high are just 2-3%, and this can never be the top. This can be a correction, but this can never be a major bull market top. It has to have euphoria. It has to have a lot of IPOs. It has to have a lot of F&O stocks in band. Only then a major bull market top happens. Currently, it's nowhere near the top. At best, as I told you, it can be a short, a brief break or a breather, but eventually we are seeing a major bull market ahead of us. So this is, and as I show, the American diaspora, as I told you, there also solid gains are made. And today is our time in India as well, that now we are at a cusp of a major bull market. And when markets move higher, it's very difficult for investors put in their money. You know, when Nifty reaches 20,000, 25,000, now is a time when markets are consolidating, when there is fear, people don't want to take risk. It's time to put our investors in the market, number one. And second, and the best option is, if they want high alpha, let their money come in small and mid caps, because over here now we are going to see a major performance. And just as a matter of disclaimer, we have this NFO that's open, and that predominantly invest in mid and small cap. But broadly, I think I have given you facts and figures without giving my own opinion, where we are standing today in terms of this major bull market. Structurally, we are going to have a solid bull market in next 10 years, because India is, I've been telling, youngest democracy, growing sustainably at 6-7%, which no other country is growing at this rate. And there is a whole lot of money that has been printed during COVID times is going to come to India. The money, long-term money, may not go to China, Taiwan, Russia. It's all going to come to India. And let's be ready, and let's have a solid joyride for our investors and ourselves, that we are going to make massive wealth in India for our investors. And this is, we need to tell him and remain invested. And mid and small caps will deliver far higher return. Thank you, and over to Chirag.
Thank you so much, Mr. Umesh Mehta, for such an insightful presentations. There are a lot of very good questions coming in. Mr. Umesh, you might want to have a look at them and then we can answer one by one. Meanwhile, there's Mr. Karthik who wants to have like one more look at the US stock performance, which was probably your last slide, I think.
I will.
Mr. Karthik, if you have any specific questions based on that slide, you might want to post it on the Q&A section. I would also request all the participants to post all their questions in the Q&A section so that we can answer them in an organized fashion.
So these are the average annual returns, and these are the compounded CAGR returns of small caps over here, large caps over here. Chirag.
I'll start with one question that I see, which is like an interesting question. And then there are a lot of market specific questions, which I think you can look and answer them. But Mr. Hitesh wants to know that, is this the right time to invest in the market in an SIP mode rather than a lump sum mode?
See, because as I told you, SIP mode is when markets are at, there is euphoria and markets are at all-time highs. In terms of real market, not the current setup. Currently, although the markets are at high, but the internal breath is still very, very benign. And therefore, as more and more people realize that, I need to invest in equities, those are the times when. So to answer in substance, now is the time to invest in lump sum because sentiments are weak. People are still skeptic about bull market, and therefore lump sum is a good indicator to invest. When there are so many IPOs coming in and when there is euphoria, that's the time we need to have an SIP because ultimately investors' money is there. He is saving and therefore he is saving and it's our duty to get his money in equity. Whether from a long-term perspective, he is going to make much better return rather than keeping money idle or from or he may in fact spend. So that time SIP is a far better mode. But because now there is fear, the sentiments are weaker, it's time to invest lump sum amount.
Okay. There's one question from Mr. Anil, which says that don't you think if global recession sets in, then Indian markets may look higher on valuation, looking at the forward PE?
Okay, great. See, recession is a nominal phenomenon. It's not a black swan event. So over past 100 years, when we see recession is a number, people know that for 2 quarters, if GDP contracts, it's a recession. But those seeds are sown earlier. So it's not new. People know that there is a slowdown and ground level. It will take time for the economy to show up those numbers. And therefore, stock market is a far intelligent machine, far intelligent brain. They foresee all these things in advance and therefore they already discount. They know. So there are so many times in the history we have seen when actual recession sets in, stock markets have moved higher and to many surprise, how this can happen. But yeah, actually stock market has its own wisdom. They are far more intelligent than average brain on the street. So yeah, that's the reality. So we should not worry. And recession, if at all it happens, it's going to happen in USA. So if you see year till date, our Indian market is up by say around 7-8%. US market is down by 5-6%. So it's there, it's known. So why will you as India fall if there is recession out there in a neighboring country? So that's how we should look at it. We are growing at 7-8%. We had all the levers. Our competitor China has moved lower, so obviously we have benefited a lot, and this is how world economy moves. It's like competition weakens, we become stronger. So we have become stronger. We have a great democracy. We have a great judiciary. We have a young population. So all these things are a great way to bring the global bull market. And I'm telling you, not only Indian investor, the Indian investor will come, and it's our duty to tell him now. But global investor, when they realize, they will also come in a big way. and then our investors will not be able to invest at 25,000 Nifty, because when global investor come, they just press the button and I want to buy in India, and India is my, so that's how they buy. So our investors don't do that. But when markets are reasonable, let's ask our investor to put in the money.
There's one question by the same attendee, that if you're bullish on mid and small cap now, does this indicate that the flexi cap fund will also concentrate more on small and mid cap now?
So in flexi cap as a category, our numbers are far higher than the average category the flexi cap has. But we have curated portfolio, as I told you. See, large cap is not necessarily a bad. In general, in aggregate, this is what the average numbers are. But there are certain good companies, obviously, which has got the great potential, and we measure this potential by the compounding factor. If the compounding factor is high, whether it is small, mid, or large, is immaterial. We need to pick and choose all those great businesses for our investors. And as matter of our flexi cap, we have a good number, a good percentage in small and mid caps as well. It's not just we are above category average in terms of holding mid and small caps.
There's one question by Mr. Sanjeev Singh, and he wants to know that how will the results fare in the coming 2 quarters, and should we recommend investments in a staggered way if the results expectation is conducive or unfavorable?
See, results, now the market is a diaspora of so many sectors, so many indices, so in a way, certain sectors are performing and will perform well. Certain sectors will not perform or have a steady state return. So for example, PSU banks. So PSU banks have performed well because they have given a great, fantastic quarterly numbers, and therefore those prices have shot up. But does that mean that now is the time to invest in PSU banks, PSU sector as a whole? Answer is no. See, because market has a habit of over discounting in the short to near term. So a good thing has happened, market will overreact or over discount. Therefore, as investor, we shouldn't be investing in those kind of things. But where markets are down for XYZ reason, for example, IT. So markets will overreact, and therefore, as investor, it is far more profitable to invest in when the sectors are beaten down and markets beat down them more. So that high alpha becomes very easy for investors to generate when they enter into all those sectors. So currently, there are few sectors which are still lagging and underperforming. I think the major part is IT, consumer durables. You have something even on the realty space. You have something also on the pharma space that are offering that potential. I think the rest are pretty much on the higher side.
For the audience, Mr. Umesh Mehta has also answered a couple of questions a couple of other questions in the current answer. So I will not be covering those questions because he's already spoken about sectors, etc. There's one question, Umesh, from Ajay, Mr. Ajay, and he wants to know that do you see that there'll be some downtrend because of Christmas and New Year holidays and FIs will be on holiday? Will this be a good time to invest, enter via lump sum mode?
So I think this is a great question, and the answer to this will be applicable to everyone. And this, I can tell you, I have from 1978 read each and every day of newspaper of Times of India. So 1979 is where your BSE Sensex data is available, those price actions. Every single day when I read, there is some or the other form of fear. And this fear keeps off investor from investing. Please understand. And this is where my learning is, my understanding as an investor is, I am on your side. Please understand, I am sitting on the investor side. We have to reduce this, the equation that, oh my God, this fear is there, Christmas is there, inflation is there, recession is there. See, today as an investor, if I have money in my pocket, it's my duty to deploy in great businesses. I am buying and owning great businesses, and I'm sitting for 10, 20 years because I want to compound my money at a far superior rate. This is what thought process that investors should have, and not little bit here and there. If Christmas comes or budget comes or election comes, shall I wait? Actually, he keeps on waiting. So the hardest thing is we just have to catch his hand and tell you just jump in and jump in quality. Sooner or later, he will realize that wow, when the quality starts showing value, he's saying, wow, it is a blessing that I entered into a market, because some or the other fear was always there, whether it was assassination of Indira Gandhi or Rajiv Gandhi or some 9/11 war. Every point in time, there is fear. And therefore, it's our duty to educate our investors and tell him, don't worry. If you have money right now in the pocket, you please invest. Otherwise, you will spend somewhere else and the value will be zero. So if you invest in equities, at least 3-5 years down the line, you will see an appreciating portfolio.
There's one interesting question. There's no name, so I'll just read out the question. How many stocks will you have in small and mid cap in your ELSS portfolio? And will that be the focus? Also, will you look at value or look at growth or both?
So 35 is the number of stocks that we will have in a portfolio. So I will just quickly add half a minute, why 35? So the best practices on this planet for asset manager is to have the number fixated, that if I, as Umeshkumar Mehta, if I'm an asset manager, or even if I'm an investor, I need to fix my portfolio 35. So it's like this, Umesh Mehta, you can only have 10 shorts in your wardrobe. So I will always have the best 10. But if I don't have limit, the 20th short in my wardrobe, I will not be able to wear before you. So this is how human psychology works. This is how asset managers work. This is how we as fund managers also work. So if we have fixated our number that, look, I am going to deliver, I am going to work with 35 best that we can offer, I think this is a far superior way, a far superior process of asset managers to work for investors and investors' money. So that's the number that we would fix it. And what was the second question, Chirag?
1 second, I'll just scroll back. The second question was that will you focus on value and growth or both? I mean, value or growth, or value and growth both together?
So as I told you, for the past 100 years, and this is what in our earlier part we have said, that when we look at 100 years of US market, when we break up the component of value and growth, over the last 100 years, the proportion of value that has created wealth is 20%, and proportion of growth that has created wealth is around 80%. So I think 80% is where the growth is, because ultimately, if you understand, it's the cash flow that the company generates and then reinvest, and that when it gets compound, that creates the major wealth, rather than buying at one cigar pop. And Warren Buffett has also, I think, he has also moved from value to growth. When Charlie came in his life, and when Charlie said that, hey Warren, what are you doing? If you keep on buying shares which are currently available for that at margin of safety, or the valuation is low, you cannot buy it all the time, because you have money and you have to deploy. You need to think from companies that are compounding, companies that are growing and reinvesting, and therefore you have to switch from value to growth. And that's how he has also made that big wealth. And logically also, I think this is far more better, because eventually the bigger compounding is going to happen when companies are able to reinvest, grow and compound their wealth at incremental higher rates of capital.
One question which says that since your ELSS fund is predominantly focused on mid and small cap, will you also be coming with a separate mid and small cap fund in the near future? And I picked up this question because I remember you talking about it as also looking at this ELSS scheme in a different angle. So, it's a great question.
So what we are saying is, because currently small and mid cap as a combination, forget in all other category, mid and small cap as a combination is not available. So what we are saying is, we will create a solid 35 stock portfolio from mid and small cap perspective, which has got the ability to deliver high potential. So tax is just an advantage. It's just an advantage that people will have. But the real crux is the fiction of law of 3-year lock-in. I think that's a super beautiful combination that we can give to our investors. That look, if this is a 3-year lock-in, let's put in a small and mid cap, because now you will see in your portfolio a great green number when you open the after your tijori or lockers after 3 years. That's how I think that's unique. So this is actually for us a mid and small cap fund. But yeah, ELSS is tax advantage is just an added icing on the cake.
Got it. There's one question from Mr. Sachin which says that global market are not bullish, and will domestic markets sustain this rally and will not come under pressure that since whatever is happening around us in the world, do you think that will come under pressure and even domestic markets will kind of not be bullish?
Okay, I think this is a great question, and if you all can permit, I will take 2.5 minutes to explain you a historical perspective. How people have made the same mistakes. Experts have also dubbed the market that will not move higher, and recession and all this flux will take market lower. So this is 1950s. Yeah, exactly 1950, sometimes in the mid of 1950. And in Americas, and for that matter, all across the world, the pundits, the so-called smart pundits, have dubbed that now markets are not moving higher. There is going to be a recession because World War II is over. The rebuild demanding, the remaking of the all these demands will now not come in because inflation was high, and because inflation was high, interest rate was also high. So people started putting money in bonds, which currently also is a scenario that interest rate is high. Let's put our money in fixed deposits and bond. They all have not studied history. 1950, as I told you, 75% of smartest of the smart investor had parked their money in bonds and fixed income instruments, but they all were wrong. From 1950s to 60s and 65, 10x return was made in America, but majority of investors were not able to participate of the same thought process. America at that time was also resilient or strong. What we said, India is also strong because relatively India has outperformed. India is up by 7-8% compared to US market by 5-6%, or for that matter, China and Russia. But those countries have their own problem. Europe has its own problem. India has not similar problem. So India is unique. Why will India fall? Same way, in 1950s, people expected that USA will fall. But why will USA fall? Because Europe was under shamble, because they were under war. America was a beneficiary. America was not involved in a major way in World War II. So America had not to fall. But still investors thought relatively America had performed higher, so let's not invest, let's wait for correction. Similarly, people are taking this as India. They are waiting that India will also fall. India will not fall. Today, if our Prime Minister is sitting behind next to most powerful person, Biden in G7, or for that matter, Saudi King Prince is coming to India. We are the most beautiful girl on this planet. Everyone wants to get married, and we are only running away. So I think this is a great time. India, next 10 years, we are going to make massive wealth, and it's our duty to tell our investors, look, this is the time. If Nifty becomes 25,000, you will not be able to invest. Now is the time when sentiments are bad, negative. You put in your money, put in your lump sum money, and then you see the magic. Sit tight. At least 3 years is the minimum. So this is our lock-in product. You sit here. Whether or not tax advantage is an add-on advantage, but you will get a 35 quality stock portfolio of mid and small cap. As you've seen in America, those 15 years from 1929 to 45, solid outperformance was there. And this is the time in India, and this is a quality portfolio. You can lock in and sit tight and see the magic of Indian bull market.
Mr. Umesh, we'll take 2 more questions. A lot of questions still flowing in. So if you're up, we can take a couple of more, but we'll take 2 more and then we can wrap up the session. There's this one very honest question from Mr. Sunil, and he's just joined as a mutual fund distributor. So he says that I've joined the mutual fund distributor club and I'm going to onboard a lot of investors. He's worried that if I start get these clients on board now at a market high, their portfolios might not look good in next 1 or 2 years. So how should I look at this? I mean, how should I manage this situation?
See, as I'm talking to so many our distributor partners, and they've created huge corpus, and the advice to our young guy, and I think first of all, congratulations that you have entered this profession. But what you have to tell your investor, look, it is possible next 2-3 months, 6 months, you will see a red. Possible. It is possible you may see a green. But that is not the purpose. Your aim and purpose has to be, I am buying great businesses, I am investing in equities, and my aim is next 3, 5, 10 years down the line. That is how you should say him at the upfront, and tell him, make the expectations clear that, look, assuming when you invest, market will fall. But don't panic. Ultimately, the great wealth has been created by everyone on this planet by remaining invested in equity and good quality equities. This is what you have to say. And we as Samco, our exercise framework, we focus on absolute quality, great quality businesses which have got pricing power, no debt, companies are able to convert their working capital cycle into cash, or companies that have got high compounding factor. See, all these companies will eventually deliver, and they are going to deliver. It may not happen in next 2-3 months, but over a period of 3, 5, 10 years down the line, quality will way outperform. And that's the kind of return that your investors should expect. But short term, please tell them equity market is not for short term. So don't expect for next 2-3 months, and you make the expectation clear wherever you go. See, whichever mutual fund or whichever equity direct he may not invest. But I think that's a bigger thing that you have to do in his life, his or her life, that tell him and set the expectation clear.
Thank you so much, Umesh bhai. Mr. Pradeep, we've already answered that question on value or growth or small and mid cap, and how many stocks we'll focus on. One last questions that we have is that Lok Sabha elections will be in 2024. So, where do you see the markets by that time?
See, we are not astrologer, and for that matter, we will not be able to predict who is going to come, who is not going to not come. But at best, what we can say is similar period was there sometimes in 2013 or prior to the Modi government re-election, 2014. So everyone was of that same, India is going nowhere. There is fear. God knows which government is going to come. But those were the time to accumulate. And going forward, assuming we have that same hibernation, assuming we have that same narratives that which government will come, or for that matter, investors are not ready to take on risk, that's the time to put in money. And that's how investors will be far better than trying to predict which government or may not come.
I think that's it for today. We still have a lot of questions coming in, but I see a lot of answers we've already covered in other questions that we took up. Thank you so much, Mr. Umesh Mehta, and thank you so much. Hundreds of distributors have joined in. I'm so glad that a lot of good feedback is coming in on the chat. Thank you so much for taking our time and joining us today for the markets meetup. We'll keep doing such sessions for you to try and give you more such insights on markets from our in-house experts. Thank you so much for today, and have a good evening.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.